Welcome back. Recently, one of the world's top rating agencies, Standard & Poor's, downgraded Nigeria's long-term credit rating from B to B negative. And this comes barely a month after lowering the nation's outlook from stable to negative. And that's not all. Now, another ratings agency, Fitch, downgraded the long-term issuer default rating of Zenith Bank, GT Bank and UBA to B, while viability rating is also shifted to B. 10 other banks also have their rating watch placed on negative. Now, to make sense of these ratings, let's join Mr. Ayodiji Ebo, who's the Managing Director of AfriInvest Securities Limited, for some insight. Good morning, Mr. Ebo. Now, let's start with a breakdown of the S&P ratings. What are the implications for the country?
Yes, thanks for having me. I feel from some of these ratings also come a little bit late. We've seen investors begin to react ahead of the rating by the Standard and Poor's, as well as Fitch. If you look at the Eurobond market in the last 2 or 3 weeks, we've seen significant sell-off, which shows that investors are wary of Nigeria not defaulting in terms of its obligation. You'll see yield rose from single-digit levels to close to between 12 and 14% within the Eurobond space. The same goes to even the corporate space. And so the implication of some of this rating reaffirming how vulnerable Nigeria is in terms of settlement of its debt. If you looking at our debt obligations, external debt, if you apply the new exchange rate, will be about 9.7 trillion naira. That's also very significant. And you also look at it in terms of dollar terms, it's still also very significant. And what investors are putting their eyes on is our external reserves. The consistent depletion of the external reserves vis-a-vis the lower crude oil prices. As at this morning is around 22, I think the Brent crude is around $22 per barrel. So with that, investors are trying to see how will Nigeria be able to improve or accrete its reserves amidst this decline in crude oil prices. And you also want to look at in terms of even what the reserves is saying. At $37.5 billion, that's an average of 30 days. If you look at based on current position, maybe less than $35 billion. So in that light, investors are trying to react ahead before we get to a situation where Nigeria, though it's really very slim for Nigeria to default on its obligation, since we still have access to dollar revenues, though it's declined significantly by over 50 or 60% significantly. The chances are very slim, but rating agency will look at based on available data, based on information that are available to them before they provide their rating. So by and large, it shows that in terms of vulnerability of the Nigerian economy is really very high amidst this COVID-19 crisis, amidst the lower oil prices, as well as the declining reserves. So by and large, it just shows that Nigeria is vulnerable, significantly vulnerable amidst these challenges.
Now, talking about the vulnerability of Nigeria's economy, now the S&P says it's unlikely that the country will be able to mitigate the effect of low oil prices and at the same time meet financial obligations with falling foreign reserves, which is what informed the rating now, despite the adjustment to the FX pressures. Now, but could that really be the case for Nigeria?
Yes, that's when you look at the last budget. If you look at the debt servicing as a proportion of actual revenue, not projected revenue now, it will be close to 60 to 7% in terms of debt servicing ratio to actual revenue. So with these lower oil prices, it means that debt servicing ratio as a proportion of actual revenue would be over 100%. That is a major signal, which is negative. So investors will be looking at how will Nigeria be able to service its debt? How will Nigeria be able to pay back its obligation? But we feel because looking at the implication of a default that it will have on the overall rating, the Nigeria will still find a way to see how, especially keeping up to the coupon. We don't see, there's no maturity in terms of Eurobond this year, so there's no major payment obligation apart from the coupons that they need to meet up with. So I feel we would still weather the storm. We will still be able to meet up with the coupon obligation that comes every 6 months. Based on available data, it shows that the situation is serious, and it's something that calls for worry.
But where does the rating become relevant for Nigeria, since the government has discontinued plans to return to the European market and global investors have retreated all investment plans in view of the COVID-19 effects?
Yes, what we would likely see is Nigeria will revert to the domestic market. If you look at the bond auction last year, there was significant under allotment. It means that investors are requesting for higher rates for them to put in their investments at this time. And why we saw that lower allotment was that DMO was not willing to move the rate beyond a certain level. But if this persists, we would see the DMO will have no other option than to raise it for them to raise funds to finance their obligations. So going into the Eurobond market now, it's in this time of uncertainty, rates will be very high, and with even the downgrades that we've seen in recent times, I know that the government will not attempt that at this period. So what we would see is a shift in focus to the domestic market. We would see in terms of increase in rates within the short term, because as investors continue to demand for higher rates, the government may not have any option than for them to be able to meet up with that rate if they actually need to raise the fund. And actually, they need to raise this fund because oil revenue, which is a major dependent or a major variable which has been used for the budget, has declined significantly and may continue to decline. So the government, as much as possible, would want to raise more domestic debt, both short-term and long-term debt.
Ayodeji, now let's talk about Fitch ratings on 3 Tier 1 banks now, GT Bank, Zenith and UBA. Of course, the CBN has always maintained that our local lenders remain stable. But why do we keep having divergent views between the regulator and that of the rating agencies?
Yes, you know that companies operate within an economy. So it's unlikely that you will have a higher rating than the economy where you operate. So those companies may, in terms of financial stability, may be stronger, maybe stronger than the Nigerian economy in terms of balance sheet size. But in terms of when it comes to rating, it's going to be tied to the economy where you operate most times, because the sovereign is adjudged to be risk-free. So there will be some form of element, because for the corporate, one, they can't print naira to meet their obligations. Also, they don't have direct access to the dollar. So that sends some form of risk to investors. But when you look at it in terms of how strong the financials or those banks are, you would see that there have been significant improvements in terms of their shareholders' funds. There's been more, we have more buffer relative to what we used to have in 2016 when the crisis, when we had the recession. So we feel that in terms of fundamentals, banks still remain very strong. CBN also writes from its own angle that the banks have more power now to withstand crisis relative to what it used to be. But when it comes to rating will be tied to your sovereign rating, and that is what I feel has impacted on the rating of the top banks, top Nigerian banks.
Fitch also placed the long-term issuer default rating and viability rating of all 10 rated banks on rating watch negative, as a sort of a watch list, with exemption of Stanbic IBTC. Talk to us about the implications of the ratings for the 10 banks, and why was Stanbic IBTC exempted?
Yes, I feel that the major reason why uh, Stanbic may be exempted may be its affiliation with its foreign with its parent company in South Africa, the Standard Bank. That may also provide, they may be able to get access to dollars from the parent company relative to other banks that have their parent companies situated in Nigeria. But when you look at in terms of fundamentals, what the rating agency is looking at, or what those rating agencies are looking at, is in terms of the reserves. So they can see the company where they operate, the external reserves have continued to decline significantly and currently almost at $35 billion. And the ability to even increase or to accrete the reserves in the short to medium term is also constrained on the back of lower crude oil prices. So adding this together, the rating agency would has downgraded in terms of the outlook, the ability for us to default. It's not, yes, it may, in terms of perception, for especially, it's going to affect them, for most of them that have Eurobond, it's going to affect the investment in Eurobonds of these companies, because for most of the fund managers also have minimum rating of investment before they can take position. So with this downgrade, we would continue to see sell-off of Nigeria corporate Eurobonds, as well as the sovereign Eurobonds. But but looking at the interest rate environment, for some of those banks, they may also take advantage of using commercial paper or bonds to take advantage of the domestic market and raise capital to fund their funding needs. So we feel that there will be more focus for even the Nigerian banks looking at Nigeria, looking within to raise capital to fund any fund requirements. That is what I feel that would see. And looking at its impact in terms of equities, we've seen significant volume in most of these top banks, looking at in terms of their multiples. For the likes of GTB, Zenith, you can see their multiples have dropped. GTB have dropped from over 2 times price to book to about 0.8 times, if not lower, around, I think around 0.5 times. And you can see in terms of multiples, they are trading very cheap. And that is why we've continued to see volumes. We saw investors staked about 3.4 billion in Zenith alone just last week. We also saw significant investment in GT Bank. So despite even this rating, investors, especially the local investors that are not exposed to any major devaluation, will be taking advantage of these lower prices, especially for investors that have between 1 to 2 years investment horizon, would be taking advantage to buy at these lower prices with the hope that things would improve within the next 1 year and they can be able to reap significant return for the risks they are taking now. So I think that's the major impact that we may see across the fixed income market as well as the equities market.
But apart from the effects of COVID-19 now, could the minimum LDR of 65% and the CRR debit also be a factor for this ratings watch negative on the 10 banks?
Yes, you are right. It would also have an impact because if you look at existing loan books, with the major challenges that really going on within the economy, the lockdown, reduction in activities, for most of those loans will need to be restructured. And we could see, I think about 2 weeks ago, when CBN was trying to, as part of its stimulus packages, they also mentioned that banks should begin to see how they want to restructure some of these loans because of the reduction in business activity. So in terms of non-performing loan, or what we may call impairment charges, yes, we expect it to spike in the short to medium term. And most of the loans will have to be restructured, which will impact on stability. Yes, investors are aware of that, but we also know that whether it's going to take 3 months, take 6 months, so the impact of the COVID-19 in Nigeria, because our growth rate is our was still in a fragile position before contagion. So we see Nigeria go down into a recession, but over time would pick up within the next 1 to 2 years, and we'll see most of the companies in terms of their prices also come back significantly.
Managing Director of AfriInvest Securities Limited, Ayodiji Ebo, thanks for speaking with us this morning. Well, it's time to do a quick review of last week's performance at the market, and Edidiong Iwang joins me now to give us the numbers. Good morning, Eddie. Well, the Nigerian stock market plunged 1.52% last week. Was there any other factor responsible for the drop apart from the impact of COVID-19?
Good morning, BC. Well, the global economy and financial markets have been roiled by the global pandemic COVID-19. The Nigerian equities market has seen sell-offs over the past month, with several stocks trading at historic lows, breaking levels last seen in the previous oil crisis in 2015 to 2016. So to answer your question, BC, the continued slide in oil prices also has a huge role to play in all of these. And, the uncertainties around the coronavirus situation continues to suppress broader market performance. Week on week, the all-share index shed, sorry about that, the all-share index was down by 1.52%. Okay, the all-share index was down by 1.52% to settle at 21,861.78 points. And also last week, the market lost about 170 billion naira. And of course, that dragged the equity cap to 11.393 trillion naira. The stock exchange witnessed 2 sessions of losses out of 5 trading sessions, and that brought the month-to-date and year-to-date returns to minus 16.61% and minus 18.55% each. In all, we saw about 101.45 billion shares worth 14.918 billion naira traded in 21,822 deals. Now, market breadth closed positive last week as the market recorded 34 gainers in contrast to 24 losers. Now, if we take a look at the sectoral chart, we see that only the financial services sectors closed the week positive. Now, for banking, that counter lost about 9% at the start of the week. So in subsequent trading days, investors took advantage of that and positioned themselves in those stocks, and that eventually lifted the sector by 2.06%. Now, consumer goods lost the most, and that was due to declines from some bellwether stocks on that counter. Nigerian breweries shared 15%, while Nestle and Dangote Sugar lost about 10% each. Now, because of those declines, those stocks were among the top 5 losers for the week. Industrial goods was also down by 0.52%. Insurance gained 3.25%. Now, for the oil and gas stocks, there was really no appetite in that sector. Of course, given what's going on, with global oil prices, that is definitely affecting stocks on that counter. So we shouldn't really be expecting any much movement in the oil and gas sector, except something happens with oil prices. Considering the current domestic and external factors, BC, sustained bearish market sentiment is expected this week, unless something happens. At the unlisted securities market, the NSE index and market cap moved up by 0.44% to settle at 692.71 and 508.84 billion naira. In all, we saw about 39.18 million units worth 22.77 million naira traded in 4 deals. At the fixed income market, the bond market, started last week on a relatively quiet note as market participants traded cautiously on the back of the MPC meeting and the bond auction. Now, towards the end of the week, we saw pockets of demand across board as Met bids at the auction, coupled with liquidity improvement, simulated a bullish bias in the market. But on Friday, the bond market closed on a positive note as average yields, were lower by 22 basis points to 7.52%. In all, we saw about 34 deals worth 23.70 billion naira. The Nigerian Treasury bills market also started last week on a quiet note with minimal activity witnessed across board, although with a bullish tilt due to fairly stable liquidity. But activity in that space maintained its weak trend for the rest of the week. The market ended Friday positive as yields declined by 10 basis points to 3.70%. And we expect a similar trend in the Treasury bills market this week. For the OMO market, average yields declined by 52 basis points on Friday to 15.55% against Thursday 16.07%. So, hopefully we'll see some more activity in the market this week, BC.
Of course, we just keep hoping for the best in spite of all the COVID-19 pandemic. Many thanks, Eddie.